I need you to understand something before I show you a single number. This morning, Pakistan bombed Kabul. Not a skirmish, not a border incident. Pakistan's Air Force struck Afghanistan's capital city before dawn. Kabul, Kandahar, Paktia, multiple provinces hit simultaneously. Pakistan's Defense Minister, Khawaja Asif, went on record this morning with 5 words. Now it is open war. 2 nuclear-armed neighbors declared war on each other at the exact same moment Silver is sitting on First Notice Day with the most structurally stressed physical delivery system in COMEX history. That is not a coincidence of timing I am going to ignore. That is the opening of today's video. Because here is what I want you to understand before anything else. Silver does not move in a vacuum. It moves at the intersection of everything that is breaking simultaneously. And right now, in the first hours of February 27th, 3 separate wars are converging on the same metal at the same time. A shooting war just started in South Asia this morning. A cartel war has been raging in Mexico since Mencho was killed 5 days ago. And a financial war has been playing out inside the COMEX for 3 months between the physical market and the paper market. Silver is sitting at the center of all 3. And today is the day all of them are due. Let me start with what happened 2 days ago, because nothing else in this video makes sense without it. On February 25th at 12:11 in the afternoon, the world's most important silver market went dark. CME Group halted all metals and natural gas trading on GlobeX. Silver had been advancing past $91 for the first time in weeks. Every standing buy order you had placed that morning was wiped from the system when it came back. Natural gas resumed trading in about 50 minutes. Metals stayed completely dark for 90 minutes. Gold, silver, copper, not reopening until 1:45 Central Time. When silver came back, it had been slammed from $91 to $84.98 across 3 consecutive selling waves. The advance was over. The pressure on the short side was gone. CME Group's official explanation for why the exchange that prices silver for the entire Western world shut down in the middle of a trading day? 2 words. Technical issues. No press release with specifics. No independent audit announced. No technical postmortem. 2 words on a status page. And then silence. I'm not going to tell you what happened during those 90 minutes. I'm going to show you the pattern surrounding them. Because the pattern does not require speculation. It only requires memory. On November 27th and 28th of 2025, less than 3 months ago, CME suffered a 10-hour shutdown. The initial explanation was a cooling system failure at their data center in Aurora, Illinois. That explanation was later quietly revised when CyrusOne, the data center operator, admitted to Bloomberg that the real cause was human error. Staff failed to follow standard procedures for draining cooling towers before freezing temperatures. The backup data center in New York was available. CME chose not to activate it. The November halt lasted over 10 hours, and it fell precisely on First Notice Day for the December 2025 silver contract. Now look at the February 25th halt. It fell precisely 48 hours before First Notice Day for the March 2026 silver contract. 2 halts, 3 months apart, both landing within 48 hours of First Notice Day for consecutive contract months. Both while silver was advancing toward resistance levels that threatened the short side of the trade. Both resulting in lower prices when trading resumed. Both explained with the minimum possible public disclosure. You can call the first one infrastructure failure. The second one is a pattern. But here is what I want you to feel before I walk you through the vault data, because this is the part that kept me up on Wednesday night going through every number I could find. After the November halt, silver went from $53 to $121.79 in 60 days, a 120% move. Then the CME hiked silver margin requirements by approximately 50% over 2 weeks, triggering forced liquidations that crashed silver from $121 to $63 in days. Then silver recovered, climbed all the way back to $91, the exact same resistance level, with the exact same delivery pressure building underneath it. And at 12:11 on a Wednesday afternoon, the exchange went dark again. Silver is at 90.41 right now, as of this morning, February 27th. It is First Notice Day, and every structural condition that existed before the halt still exists right now. The halt did not fix a single thing. It bought 2 days. Those 2 days are now over. Let me show you the vault, because this is where the paper market meets the physical reality it has been trying to outrun. COMEX registered silver, the only metal that can legally be delivered against a futures contract, stands at 86.13 million ounces as of the most recent confirmed report. That is the floor. That is everything the exchange has to back its delivery obligations. In October 2025, that number was 167.7 million ounces. In 2020, it was 346 million ounces. What you're looking at right now is a 75% collapse in the physical foundation of the world's primary silver futures market in 5 years. And it is draining at 785,000 ounces every single trading day. 750,000 ounces. Gone. not replaced. Now here is the delivery data that tells you why. Read these numbers carefully because there is no historical analog for what they show. Full year 2024, COMEX silver deliveries totaled 203 million ounces. Full year 2025, that number became 474 million ounces, a doubling in a single calendar year. December 2025 alone saw 46.6 million ounces delivered. That is 50% of the entire current registered inventory consumed in a single month. January 2026 recorded 49.4 million ounces delivered. January is not a major delivery month. It is supposed to be quiet, a rollover month. Historical January averages run 6 to 7 million ounces. January 2026 delivered 7 times that. And February's delivery rate is running at 98% of standing contracts. Write that again, 98%. In a normal functioning futures market, delivery rates run 2 to 5%. 10% is elevated. 20% is alarming. Anything above 30% has never happened in the modern history of this market. February 2026 hit 98%. That is not a market where participants are rolling forward and taking cash settlements. That is a market where institutional participants have made a deliberate, coordinated decision that they want the physical bars, not the paper promise, the bars. When that is your delivery rate, you're not watching a futures market anymore. You're watching a run on the bank, and today is first notice day for March, the day every long holder of a March contract can formally declare, I want the metal. Now let me show you the signals from London that the paper market has been hoping nobody would connect to the COMEX numbers. Because the physical scarcity is not a New York story, it is a global story. And the place it shows up first is always London. London silver lease rates peaked at 34.9% annualized on October 9th, 2025. Bruce Ikemezu, former Tokyo Precious Metals Banking Director and head of the Japan Bullion Market Association, confirmed intraday rates reached 39.2% that same day. I want you to understand what those numbers mean in context. Normal silver lease rates run below 1%. Below 1%. The October peak was nearly 40 times the historical norm. That is not a market fluctuation. That is a market screaming that physical silver is not available at any price the paper market is willing to acknowledge. When you need to borrow physical silver for institutional delivery, and the cost to borrow it for a single month runs at 35% annualized, you are paying 35 cents per dollar per year just to access metal. You need for obligations, you cannot fulfill any other way. Nobody pays that rate unless they have no other option. Those rates have come down from the October peak. But the structural condition that drove them to 39% has not resolved. The vault is smaller today than it was in October. The delivery demand is higher today than it was in October. The supply chain replenishment is more disrupted today than it was in October. And that last point brings me to the war that started long before this morning's bombing runs. The primary source of refined silver bars flowing into COMEX warehouses is Mexico, the world's largest silver-producing nation. Under normal conditions, refined bars move from Mexican smelting operations through logistics networks into COMEX-approved depositories and replenish the inventory that physical deliveries drain. That flow has been disrupted since Mencho was killed on February 22nd. The CJNG power vacuum that opened after his death has triggered retaliatory violence across 20 Mexican states. Transportation insurance for refined silver bars in the key producing regions is currently unobtainable. Some operations have shifted to transporting raw ore outside Mexico for refining elsewhere, adding weeks to the pipeline. Vizsla Silver's Panuco deposit, the world's largest undeveloped high-grade silver resource at over 100 million ounces, remains fully suspended after 5 workers were killed and 5 more went missing in January. The cartel war in Mexico is a silver supply war. It just does not get called that. And this morning, Pakistan bombed Kabul. Pakistan and Afghanistan do not produce significant quantities of silver. Let me be direct about that, so this is not misread. The war itself does not disrupt silver supply directly. What it does is something more important for where silver goes from here. 2 nuclear-armed neighbors declaring open war is the kind of geopolitical event that sends institutional money toward hard assets simultaneously. Gold is already at $5,170 and moving higher this morning. Silver at $90 in an environment where gold is at $5,178 implies a gold-silver ratio of 57.4 to 1. The historical average is closer to 40 to 1. A ratio compressing from 57 toward 40 against gold at $5,178 puts silver at 129. The war in South Asia did not create silver's physical shortage, but it created the macro environment in which every institutional dollar that has been sitting on the sidelines trying to decide whether to enter precious metals just received a very loud signal. And the physical market they are entering is the most constrained it has been in the documented history of COMEX. Now I want to bring you something that almost nobody is connecting to the halt. because it is the data point that changes how you read everything else I have shown you. On February 12th, 13 days before the CME halt, a routine regulatory filing was published through the SEC, a 13F. This is the document that large institutional investors file each quarter to disclose their holdings. The filing was from Jane Street. Jane Street, if you do not know the name, is one of the most aggressive quantitative trading operations on earth, built for speed, arbitrage, and flow extraction. Not a passive long-only fund, a firm that profits from moving faster than the market can see. The filing revealed that as of December 31st, Jane Street held 20,605 shares of SLV, the iShares Silver Trust, the world's largest silver ETF. Jane Street is now the single largest holder of SLV in the world, larger than BlackRock at 20.5 million shares, larger than Morgan Stanley at 18.1 million, larger than Bank of America at 10.5 million. Now here is the number that should stop you cold. As of September 30th, 2025, Jane Street held 41,100 shares of SLV. By December 31st, that number was 20,672,737. That is a position that grew by more than 50,000% in 90 days. Jane Street became the world's largest SLV holder in a single quarter. The filing disclosing that position was made public 13 days before the CME halted silver trading for 90 minutes. But here is the detail that changes how you read that position entirely. The same 13F filing reveals that Jane Street simultaneously holds 39.5 million SLV call options and 43.3 million SLV put options. More contracts in options than in shares, and roughly equal calls and puts. That is not a bullish position. That is not a bearish position. That is a volatility position. When you hold that many calls and that many puts simultaneously, you do not profit from the direction silver moves. You profit when silver moves violently in either direction. The bigger the swing, the more you make. And look at what silver has done since that position was built. From $71 to $121.79, then a crash to $63.90, then a recovery to $91, then a halt and slam back to $84.98, then a recovery back to $90.41 right now on first notice day. If you're positioned for volatility, this market has been delivering exactly what your position requires, every single week. Jane Street is also an authorized participant in SLV. That means it has direct institutional access to exchange physical silver for SLV shares and vice versa at scale, a mechanism that retail investors cannot access under any circumstances. An authorized participant sits at the exact intersection where the paper ETF market and the physical silver market connect. It can move metal in and out of the trust in ways that are not visible in real time to anyone outside the transaction. A $1.65 billion position built at 50,000% speed, disclosed 13 days before the halt, held alongside 82.8 million combined options contracts in a volatility strategy by an entity with direct physical access to the world's largest silver ETF. That is not a passive investment. That is a structural foothold at every critical node of the silver market simultaneously. Now I want to give you the honest counterargument, because if this analysis is going to mean anything, it has to survive the strongest version of the opposing case. The November halt was caused by documented infrastructure failure. CyrusOne's own statement to Bloomberg confirmed human error in the data center. Incompetent infrastructure management and deliberate market intervention are fundamentally different things, and the documented explanation for November is the former, not the latter. Wednesday's halt also affected natural gas. Natural gas has no delivery squeeze, no vault crisis, no short side pressure problem. If the halt was designed to protect silver shorts, why did natural gas get halted with it? A genuine infrastructure failure affecting multiple product lines is more consistent with two words than a targeted intervention. And Jane Street's volatility position is entirely legal, publicly disclosed, and consistent with how the world's largest quantitative trading firms operate across dozens of markets. Building a large position ahead of an anticipated volatile event is not market manipulation. It is how these firms make money. These are genuine points. I'm not dismissing them. But here is what the counterargument cannot explain. Whether the November halt was incompetence or intervention, it fell on first notice day for December silver. Whether Wednesday's halt was incompetence or intervention, it fell 48 hours before first notice day for March silver. If CME's infrastructure is so fragile that it fails at critical delivery moments in consecutive contract months, that is its own serious indictment of an exchange that is supposed to provide neutral price discovery for a $30 trillion industrial commodity market. Incompetence at precisely the worst moments is not a defense. It is a different category of failure, one that still raises the question of why no regulatory investigation has been announced. The good till-date orders that were wiped during the halt represent an active decision about order book management, not a passive consequence of a system going dark. Someone decided those orders would not survive the restart. That decision benefited the short side of the trade at a moment when the short side was under maximum pressure from a silver price advancing toward $91. And when trading resumed, silver was down $3. Gold recovered. Silver did not recover the same way. In the same macro environment, on the same exchange, the metal with the delivery problem behaved differently from the metal without one. Now here's the forward picture, and this is the part that matters most on first notice day. The vault holds 86.13 million ounces. March delivery has begun. If the delivery rate holds anywhere near the 98% pace we have seen in recent months, the vault faces strain that cannot be managed through administrative action alone. The drain that has been running at 785,000 ounces per day has no visible source of replenishment. Mexico is disrupted. London lease rates that reach 39% confirm the eastern end of the supply chain is equally constrained. China classified silver as a strategic material with export licenses restricted to 44 approved companies, reducing refined supply by an estimated 40%. May open interest currently sits at 350 million ounces against 86 million registered ounces, a 4-to-1 ratio, and it is still growing as the final March rolls. Complete. Whatever pressure was compressed by Wednesday's halt has already been replaced and exceeded by the forward contract structure that is loading into May right now. The can was kicked forward. The road ahead is shorter than the distance behind. Here's what you watch from this point. Watch the CME Vault report each evening at 6 p.m. Eastern. Every night's report is the first data point on whether the March delivery drain is accelerating or stabilizing. Watch whether any eligible to registered transfers appear, because those conversions require willing sellers. And at a time when physical silver commands substantial premiums over COMEX in the real world, the incentive to warrant metal into exchange delivery is competing against the incentive to sell it directly at higher prices. Watch March delivery notices as they file through the settlement period. If the 98% delivery rate continues into the March window, the math tightens to a level the exchange cannot manage quietly. Watch May open interest weekly. If it continues building above 350 million ounces without the vault recovering, May enters its own delivery window in worse structural shape than March did when the squeeze began. Watch the Pakistan-Afghanistan conflict for escalation. Any expansion that draws in India, the United States, or regional powers creates the kind of geopolitical uncertainty that sends institutional capital into hard assets at scale. Silver at $90 in that environment becomes very difficult to short. And watch whether CME issues any additional explanation for the February 25th halt. An exchange that prices the global silver market for hundreds of millions of participants owed more than 2 words to the traders whose orders were wiped from its system during the most sensitive 90 minutes of this entire contract cycle. The fact that nothing more has been released since Wednesday is itself data. Here is what I keep coming back to this morning as Pakistan bombs Kabul and silver sits at $90.41 on first notice day. 3 wars are converging on the same metal simultaneously. A shooting war that started at 2 in the morning in South Asia, a cartel war that disrupted the world's largest silver-producing nation 5 days ago, and a financial war that has been playing out inside the COMEX for 3 months between the paper price and the physical reality underneath it. The paper price is $90.41. The physical market has been trying to tell you it is something different for weeks. London lease rates that hit 39%, delivery rates at 98%, a vault down 75% from 2020, draining at 785,000 ounces a day, a haul that lasted 90 minutes and wiped every standing buy order 2 days before the most consequential delivery deadline of this contract cycle. The halt bought 2 days. The 2 days are over. First notice day is here. The vault is smaller than when the halt happened. The wars are more active than when the halt happened. And the pressure that existed at 12:11 on Wednesday afternoon still exists at this exact moment. None of that changed. 2 words did not change any of it. The physical market already knows what the paper price has not yet admitted. And on first notice day, with Pakistan at war and a vault at 86 million ounces facing contracts written against 4 times that number, the distance between what the paper market claims and what the physical world knows is measured in delivery notices that started filing this morning. Watch them closely. The system is about to tell you which number was right.